Today, in under 20 minutes, I will provide you what you need to know if you want to invest in Tesla. I will give you the positives and negatives from the 2Q results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about Tesla, and my conclusion on Tesla's future and what you should do. So why should you listen to me? My name's Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 7 things that got me very excited and 7 red flags to watch out for with Tesla. If you're enjoying this, please smash that like button. The shift has begun. So when Amazon changed from a bookseller to the company that it is today, many investors were skeptical, but it obviously paid off. In 2Q25, Tesla officially announced that it has made the shift from leading in EV and renewables to also becoming the leader in AI and robotics. Let's cover the red flags first. Total revenues decreased 12% year over year. Sales are down because Tesla shipped fewer cars and earned less from high margin credits. Lower average selling price means that other areas of the business need to pick up the slack. The core auto business is shrinking in both units and pricing, a tough combination for profitability. If price cuts continue to drive sales, revenue per vehicle could stay depressed.
Where's my old car?
Thinner auto margins leave less cushion for hiccups in demand, new model ramps, or raw material swings. Sustained margin erosion can limit the cash available for growth bets like AI, autonomy, and new factories. Fewer cars delivered, especially in other models, suggest that demand or production bottlenecks could linger. Higher days of supply means that inventory is building, which can lead to more discounting and margin pressure.
The first among those changes is the repeal of the IRA EV credit of $7,500 by the end of this quarter. Given the abrupt change, we have limited supply of vehicles in the US this quarter, as we have already within lead times to order parts to build cars. We've rolled out all our planned incentives already and will start paring them back.
Profit is shrinking as costs rise, so Tesla is keeping a lot less of each dollar of sales than it did a year ago.
Where's my money?
Management is calling out lower regulatory credit revenue, AI and other R&D spend, declining vehicle deliveries, stock-based compensation, and tariffs, all of which can keep margins under pressure near term.
Sequentially, the cost of tariffs increased around $300 million, with approximately 2/3 of that impact in automotive and rest in energy. However, given the latency in manufacturing and sales, the full impacts will come through in the following quarters, and so costs will increase in the near term. While we are doing our best to manage these impacts, we are in an unpredictable environment on the tariff front.
These credits are pure profit, so losing $451 million creates a direct headwind to margins. With fewer credits to lean on, Tesla has to make up the profit shortfall in other parts of the business.
We will also make changes to certain emission standards by reducing the amount of penalty to zero. This in turn will have an impact on the new sales of regulatory credits to other OEMs, and in turn will lead to lower revenues. While we've never planned our business around such sales, it will nonetheless impact our total revenues.
This rule change wipes out a high margin revenue stream, and it will negatively impact margins since the regulatory credits are basically pure profit. Replacing that lost cash requires stronger auto margins or new high margin income, maybe from FSD, software, energy, or services.
Sounds hard.
But wait. There is some good news. These credits are only 2% of revenues. So if you had $100 in your wallet and you lost $2, would you lose your mind? I wouldn't.
While we've never planned our business around such sales, it will nonetheless impact our total revenues going forward.
Here's what got me really excited. Tesla has the cash and flexibility to keep investing in factories and new products, even while near-term profits are under pressure. Strong liquidity lowers the risk of a cash crunch and provides massive liquidity. A concrete production start date gives investors a timeline for one of Tesla's biggest long-term bets. Finally, the Robotaxi has rolled out in Austin, but is it better than Waymo? According to William Blair's Jed Dorsheimer, he was pleasantly surprised at how natural and non-robotic the ride felt.
We were down in Austin last week, trialing the Robotaxi, which is a beta version, comes public in September. And we also trialed Waymo through Uber. And our experience was surprising. I mean, the Tesla drove much more autonomously, felt a lot more like a person was driving that. It was a very comfortable. There were no security, safety issues that we had in any of our rides, and it surprised me to the upside. I was pleasantly surprised by this experience.
Cash generated from the core business improved versus last year, giving Tesla more room to fund projects without extra borrowing. It's helpful support while auto margins are compressed, even if it doesn't solve the near-term profit margin hit all by itself.
While operating cash flows increased sequentially, so did our CapEx, resulting in $146 million of free cash flow. We continue to make investments in various aspects of manufacturing, like the Cybercab, semi-lines, and other manufacturing spend, and the expansion of our AI initiatives.
Opening a second megapack source in China will shorten lead times and diversify the supply chain. This will help Tesla scale its energy business even while auto margins are under pressure. Added capacity in Asia positions Tesla to chase more grid-scale storage deals in APAC, a growth factor that's less tied to car pricing and incentives.
Energy is growing really well, despite headwinds from tariffs and various supply chain challenges. The megapack is expanding capacity quickly, and we have upgrades to the megapack that will make it even better. And we had record Powerwall deployments again in Q2.
EVs upending the market means the category should keep growing for years, giving leaders a better chance to rebound when the economy and incentives normalize. As legacy car makers pivot to EVs, Tesla's software updates and battery know-how can drive add-on revenue from things like subscriptions and autonomy, even if car prices stay competitive.
Some other notable things. Model Y in June became the best-selling car in Turkey, Netherlands, Switzerland, and Austria. It is, I believe, the best-selling car of any kind in the world still. Autonomy is a big factor there.
Bigger factories and supply chains lower costs per car, letting Tesla protect share while still investing in AI and autonomy. Global manufacturing and charging infrastructure can speed new model rollouts abroad, helping volume and margins improve when deliveries recover. This is what everyone is missing. In early August, Tesla quietly filed an 8K where they gave a new approval to Musk's compensation package. Yes, the same package that was struck down in court last year. So he either wins on appeal or with the new approval. Watch closely, because this will be a major news distraction, but an opportunity for savvy investors as the stock pulls back. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
Nope.
That is what you are doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. There is something really cool in Tesla's debt that I can't wait to show you. Tesla has over $37 billion of cash and investments at year-end, and almost $38 billion at the end of 2Q25. And they are net cash, which means cash is greater than debt by almost $31 billion. This gives the company a mountain of cash to invest in the future, including self-driving cars, robotaxis, and humanoid robots. Debt is currently $7.2 billion, and it has declined since year-end. But $3.4 billion is in asset-backed notes. Here's what's cool about that. They took their leases and issued debt against those leases so that they could get their money back and have it fully supported by the cash flows from the leases instead of their core business. Retained earnings grew 116% in 2023 and 26% in 2024 to over $35 billion. Tesla and Amazon are the only Mag 7 stocks to not pay a dividend, which gives them more money to reinvest in the company for the long term. So what's the takeaway? Tesla has tons of cash, its debt is manageable, and it is substantially growing retained earnings. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue growth has become negative year over year in 2025. While average selling price and product mix are big culprits, Tesla is in a transition period, so this is to be expected until new revenue sources like FSD, Robotaxis, and semis come online. Margins experienced a contraction in 2024, but they've begun to stabilize in 2025. Losing the regulatory credits will hit margins, and there was an increase in operating expenses driven by AI and other R&D projects. Net income decreased in 2024, but there's two main reasons. One, there was a $684 million one-time restructuring cost, and number two, there was a $5 billion tax benefit in 2023 from the deferred tax assets, causing a one-time artificial boost. Net income has more or less stabilized in 2025, but be prepared for some rockiness as the transition progresses. So what's the takeaway? Growth is not like it was in the past, but margin contraction appears to have stabilized as the company focuses on becoming a leader in AI and robotics. The cash flow statement tells us where the cash is generated by the company, and there are three buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and has grown rapidly the last 5 years, but leveled off the last couple years. Free cash flow has come down from 2022 through 2024. The leveling off of operating cash flow is due to the restructuring and tax benefits that we just discussed. The free cash flow decline is primarily due to the increasing capex for AI, humanoid robots, and self-driving cars. From 2022 to 2024, Tesla generated $40.7 billion in proceeds from its invested cash. This is something that we have seen with the other Mag 7 companies, and it's a sign that Tesla has excess cash to invest and that it generates passive income. Tesla has not needed to issue equity over the last 4 years. In addition, there's no dividend and no share repurchases. Tesla is self-sustaining and plowing its money back into the company for future growth. So what's the takeaway? Tesla is using the returns generated from its cash to invest in AI innovation, self-driving cars, and humanoid robots. So what do I think about Tesla and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step guide I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of approximately $1.16 trillion. We divide by the current shares outstanding. That gives us an implied share price of about $360. Compared to the recent close, that's an 8.5% discount, which is a hold rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides a margin of safety. I'll give you my thoughts on how to play Tesla stock later in the video. So what does Wall Street have to say about Tesla? Let's cover that next.
Show it to me.
Wall Street is all over the place with Tesla, and the general consensus is that it's a hold rather than a buy or sell. Guggenheim maintained a sell rating with a price target of 175. They're keeping a cautious stance heading into the second half of 2025. Morgan Stanley reaffirmed an overweight rating with a price target of 410. They said it's all about to change as Tesla's AI and robo-mobility stack broadens. Things like manufacturing, automation, robotaxi, and eVTOL optionality. Wedbush reiterated an outperform rating at a price target of $500 per share. Dan Ives argued that Tesla's long-term autonomy and AI optionality, including things like robotaxis and Optimus robots, remains the core bull driver despite near-term volatility. CapIQ gives me a sense of how other analysts on Wall Street view the company. 40 analysts cover Tesla on Wall Street. The range is from a low of 115, which is a 65% decrease, to a high of 500, which is a 52% increase. The median is 322.50, which is a 2% increase. The overall rating on a scale of 1 to 5 is 2.66, which is a hold rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Tesla. I am a big believer in the company, and it's currently the third largest position in my portfolio at a weight of 9.3%. If you decide to buy Tesla, you need to get in at a good entry point, which I'll reveal shortly. Even though the Robotaxi is just rolling out, Tesla has a massive cost advantage because of the data that it has gathered from drivers over the years. Imagine 1/10 the cost of Waymo and 1/2 the price of Uber. Robotaxi could dominate very quickly.
The cost is much lower, and so we calculate it's about 1/10 that of Waymo. And so can they use the lower cost to weaponize pricing as a way to take market share? Because they are, the David in this market. They are the newcomer into the market, and so they need to be the disruptor. And their pricing was half that of Uber, just in the small sample set of experiences that we had last week.
Expanding into heavy trucks opens a new profit center and diversifies beyond passenger cars. The Semi won't change Q2 results, but advancing production keeps the long-term growth pipeline alive.
We continue to make investments in various aspects of manufacturing, like the Cybercab, semi-lines, and other manufacturing spend, and the expansion of our AI initiatives.
Management is signaling more earnings from software and AI over time, which can carry higher margins than cars alone. This doesn't fix the Q2 margin compression today, but it lays out a path to better profitability as these software businesses scale.
I do think if Tesla continues to execute well with vehicle autonomy and humanoid robot autonomy, it will be the most valuable company in the world.
Tesla hit a 52-week high of 488.54 in mid-December, and it's down over 32% since then. Tesla is a core foundational investment that you must hold for the long term to realize its full potential. My model shows a value of $360, which is an 8.5% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Tesla is a hold at current levels, but I would be looking to buy below 300 to provide the 20% margin of safety. If you choose to invest in Tesla, do not invest simply for the electric vehicle business because that is not where the long-term value is. You must believe in the Tesla ecosystem, which includes trucking, humanoid robots, AI compute, batteries, robotaxis, and a robust charging network. If you like this and want to see another in-depth stock valuation, check out my PayPal video here or my Amazon video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.